Let's get the show on the road. Right, so the good news is Mike has arrived. He's catching his breath, and I'm still going to go first and allow Mike to go second. So I must just ask you to bear with us because the order might seem a little bit back to front to you now. So when I go through my presentation, I want you to think that you already know exactly what an ETF is, an exchange-traded fund, and how it can be used in investments. And rest assured that when Mike comes on in the second half, he will be covering that in a lot more detail in terms of what ETFs are, how they can be used in investment products, and how you can also help them to achieve your financial freedom in terms of this journey. My name is Nerina Visser. I'm the strategist and advisor at ETFSA, and I'm really responsible for not only managing many of the portfolios that we've got, but also looking at providing some insight in terms of what's inside an ETF, what are the investment performance like. And tonight in particular, I'm going to talk to you about understanding some of the impact of costs on your investments, but just as important, understanding the impact of tax on your investments, a different type of cost that we have in our investments. And finally, probably the second most often question that I get asked, the most often question that I get is, what is the best ETF? And there is no one best ETF. So I'm not even going to try and answer that question tonight. But the second most common question is, where do I start? What must I do? And especially when you see, when we talk about discretionary investments, tax-free investments, retirement annuities, what should I do first? Where do I go? How much do I put into each of these three different investment options? So thank you for coming through and sharing this opportunity with us tonight. It's wonderful to have so many of you here. I do recognize some faces, but I see a lot of new faces also. So it's wonderful to have you here with us this evening. So, understanding the impact of costs on your investments. I'm going to start with one of the first types of costs that one is confronted with, and that is transaction costs. Now, transaction costs are really the things that you've got to pay every time that you make an investment. So whether you buy or whether you sell, a transaction cost is really the cost associated with that event, actually paying something because you are either buying or selling. Now, transaction costs can be expressed either as a fixed percentage or it can be a fixed rand amount. And which of the two is cheaper or more cost effective really depends on your investment amount. So let's take an example of a brokerage rate of 0.5% of your investment. What does that really mean? So what I've done on this graph is to show you here that this is my investment amount, ranging anything from a small amount of, say, 1,000 Rand all the way up to 100,000 Rand. So if I'm paying a fixed percentage brokerage cost, and that's what's on the right-hand scale here, 0.5% of my transaction cost, how much does 0.5% translate to in terms of rands, in terms of how much I then have to pay? So you can see that if I've only got 1,000 Rand to invest down here, that 0.5% is going to be 50 Rand of my 1,000 Rand. If it is 20,000 Rand that I have to invest, I'm going to be paying 100 Rand. And so gradually the Rand amount that I pay increases as my investment amount increases, and that is because my brokerage rate, the percentage, is a fixed percentage. So you'll see that right here is there's a crossover point that says at 10,000 Rand, if I was to invest 10,000 Rand at 0.5%, it's going to cost me 50 Rand. If I invest less than that, it's going to be less than the 50 Rand. If I invest more than that, it's going to be more than that 50 Rand. That's if my brokerage rate is expressed as a percentage. But what if my investment, so in terms of that brokerage rate, the bigger the amount of money you're going to be investing, the bigger the Rand amount that you will be paying, because you're always paying a fixed proportion or a fixed percentage of that investment. So a brokerage rate that works on a percentage is very good for small investment amounts because you'll be paying a relatively small Rand amount for your brokerage. But the bigger your investment amount, the bigger the amount of money will become that you're paying for your brokerage. It's also best suited if you are making frequent investments because you actually want to make sure that you're always just paying a small portion of your investment amount. But what now if my brokerage is a fixed Rand amount? I always have to pay 50 Rand, for example, whenever I make an investment. Well, in this case, the graph looks a little bit different because now it is my brokerage amount that is fixed at 50 Rand, irrespective of what my investment amount is. And when I then express that 50 Rand as a percentage of my investment amount, you can see that it's quite a different picture. In fact, if I've got 1,000 Rand to invest, 50 Rand on 1,000 Rand, I'm paying 5% of my money in terms of investment costs. So if you've got relatively small amounts of money to invest, if you are going to go with a brokerage that charges you a fixed Rand amount, it's going to be very expensive for you in terms of your investment exposure and the cost of that investment exposure. The bigger the amount of money that you invest, the smaller that 50 Rand becomes of a percentage. So when we look at a brokerage model that has a fixed amount of money, the bigger the investment amount, the bigger the brokerage percentage. But this is very suitable for large investment amounts or if you make lump sum investments. So what I'm starting to show you here is that it's often not a simple question to say what is the cheapest, what is the easiest, what is the most cost-effective way to invest. It depends very much on what is the amount of money that you have to invest and how frequently are you going to invest. If you're doing this every single month, for example, then a fixed Rand amount cost is going to turn out to be a very expensive way for you to invest. So this is transaction costs, and transaction costs very much event-based. Every time that you buy or sell, you pay those costs. What then about administration charges? Now, administration charges is typically an annual fee. This is something that is spread over the whole year and that you pay a little bit every month or every quarter in terms of your investment. So this doesn't matter whether you're buying or selling or not. The administration charge is based on what is the total amount of money that you have invested, and there's an administration fee associated with that. Now, this can once again be a percentage or it can be a fixed Rand amount that you pay. So the impact is very much the same as it is with brokerage. The smaller your amount of money, you rather want to have a percentage-based administration fee. If you've got a big amount of money, you'd be much more comfortable paying a fixed Rand amount in terms of your investment. But this is what is key and why I started out on this basis. So often people look at those two primary costs of investments, transaction or brokerage costs and administration costs, and they add them together and they say, that's the total cost of my investment. But you can't do that because the transaction cost is something which you pay every time that you transact. That might be a monthly or it could be a quarterly fee, whereas the administration fee is an annual fee. So let me show you what I mean in terms of why you can't add these together. So if I was to take a lump sum example, and let's just say I invest a lump sum amount of 12,000 Rand at a 0.5% brokerage rate and 0.5% admin fee per annum. So when I calculate my brokerage, 0.5% of my 12,000 Rand, it's going to cost me 60 Rand to invest that 12,000 Rand. But now my administration charge, as I said, that's not an upfront lump sum amount. No, that is something that in this example I'm using a quarterly payment. So every quarter I'm going to pay 1/4 of the annual fee of 0.5%. And that on 12,000 Rand means every quarter it's going to cost me 15 Rand. 15 Rand times 4 quarters gives me 60 Rand. And my total cost now is 120 Rand, and if I express it as a percentage, it's 1%. Now you'll probably say to me, but you said I can't add the two together, it doesn't work, and here you've just showed us that it does work. It only works in this very specific case where it happens to be a quarterly fee, and what I've done here, look at my assumption, no growth in the investment. If there was growth in the investment, if that 12,000 Rand became 13 or 14 or 15,000 Rand, then that Rand amount at the end of quarter 2 will not be just the 15 Rand anymore. It will grow in line with the size of the investment. So this is the only example in which it just coincidentally works out that you can add the two together and get the same amount. Let me show you then what is the impact if we look at the debit order example. So let's say I'm going to invest the same total amount of money, the same 12,000 Rand over the year, but now I'm going to invest 1,000 Rand per month. still at a 0.5% brokerage and a 0.5% admin fee per annum. If I now calculate my brokerage, I get exactly the same answer because 12 times, because I'm doing it on a monthly basis, 12 times a 0.5% times 1,000 Rand also works out to be 60 Rand. So there's no difference in terms of how much the brokerage costs me because I'm investing a total of 12,000 Rand. It doesn't matter if I'm doing it 12 times in the year times 1,000 Rand or one lump sum amount of 12,000 Rand. The brokerage costs work out the same. But the administration charge is a different story because this is something that you're going to be paying throughout the year. And what you now find is that at the end of the first quarter, you've only invested the first 3,000 Rand after 3 months. So your administration charge, where previously it was 15 Rand because I had 12,000 Rand, for 3,000 Rand it works out at 3.75 Rand. By the end of the second quarter, I've now invested another 3,000 Rand. So now I've got a total investment of 6,000 Rand, and now my administration fee is 7.50 Rand. And so as my total amount invested grows, so does that quarterly administration fee. But the sum total of all of this only comes out at 37.50 Rand. Why? Because I started the year with a relatively small amount of money and I'm gradually building it up. And my administration fee is always just payable on whatever amount of money I have invested. So I now found that my total for my brokerage and admin is less than 100 Rand and it works out to 0.81%. Can you see that I can't add the 0.5 and the 0.5 together and say the total cost of my investment is 1%? Because you're basically adding apples and bananas together and then say, I've got fruit. You can't add things that are different together. So that's the first thing that I wanted to share with you tonight. The other thing that I wanted to talk about in terms of the impact of costs is to talk about the total expense ratio, or the TER as it's often called. So often people look at the TER and they think that that is the only cost that there's involved in my investment. So what is this total expense ratio? Well, the total expense ratio is not a cash flow expense. You don't have to take money out of your pocket to pay for it. It doesn't come out of your investment amount. So unlike the transaction and the admin charges where it was an actual cash flow out of your investment, this one, the impact that it has is that it basically you pay for it indirectly through lower performance. So let's assume that I have an investment return of 10% before any costs are taken into account. That TER reduces that 10% and give me a lower return over time. So if the TER is 0.5%, my return from my investment will only be 9.5%. It reduces the return that I get. And if the TER is higher, if it's 1.5%, now I get even less. Now it reduces to just 8.5% return that I get. So the higher the TER, the higher the total expense ratio, the lower the return that you will get from your investment. The more of your performance is actually paid away to fees in terms of that total expense ratio. Now, actively managed funds or active unit trusts, they attempt to give you what is called alpha. Alpha, which is performance that is better than this benchmark return of 10%. So they try and give you an alpha amount, an amount of excess performance that is more than what the TER impact is. So what they're saying is, you know what, I'm going to charge you 2% for this investment, but I'm going to give you more than 2% extra in terms of the investment performance. That is what they set out to do, or what they attempt to do. But unfortunately, we know that this often does not happen. In fact, you often hear us referencing the SPIVA report by S&P Dow Jones, the S&P Index versus Active report, in which they evaluate what proportion of actively managed funds are actually able to provide a return that is better than the index return. And on average, in South Africa and around the world, about 85% of all actively managed funds cannot give you a performance or a return that is better than just the index return, and therefore the passively managed investment in that index can give you. So the first thing that I want you to take away from tonight is that when you talk about costs, Understand that there are transaction costs, that there are administration costs, and that there are total expense ratios. But you can't add them all together and say, that's the total percentage that my investment is costing me. I know the maths that I showed sometimes can feel a little bit overwhelming, but it's worthwhile to actually try and convert your own investment process, the amount of money, the frequency that you do, to actually go sit and calculate in rand terms, what is it actually costing you to make the investment, taking into account the transaction charges as well as the administration charges. It definitely is worth your while. What is included in that total expense ratio, just to finish off in terms of the impact of costs? So there's some costs that are associated with an investment process that are fixed costs. So these are things like trustee fees, audit fees, regulatory charges or licensing fees and so on. And these are amounts of money that have to be paid irrespective of the size of the fund that you're talking about. So the impact of that is that the smaller the fund is, the bigger those fixed costs will be as a percentage of the fund. So that can really affect the total expense ratio of a fund very negatively if the fund is relatively small and those fixed costs are relatively high. The variable costs, on the other hand, is something that varies along with the size of the investment. So this typically would be your MANCO, or that stands for Management Committee Fee. That's really just the company who issues the product, and this is typically a relatively small amount of money that is payable to the MANCO. The big fees really sit within your asset management fee, and the asset management fee in the case of an actively managed fund is the money that is paid to the fund manager who has to make the decisions about what to buy, what to sell in the fund, and that is where the biggest part of your investment costs go into. The performance fee is the other one that can be significant, and the performance fee typically is something that is expressed as when a performance is better than a certain, what they refer to as a hurdle rate. So for example, you can say that if this investment gives me better performance than cash, 5% or 3% in the bank could give me, then the investment manager also gets an additional fee, which is a performance fee based on that performance of the fund. This can end up being a very, very big component also of the total expense ratio. But these things are only relevant in an actively managed fund. In the case of an exchange-traded fund, which is passively managed, follows an index, which Mike will talk to you about a little bit later, there are no performance fees payable, and the asset management fee is extremely low because there's no manager that has to be paid to make investment decisions. The investment is done according to the index that that ETF tracks. The final cost in terms of the total expense ratio, which is often excluded, is the trading costs. And the trading costs really varies quite significantly according to the level of activity. So if this is a fund where there's a manager that buys and sells a lot of shares, really trying to create that extra performance, that alpha performance, these transaction costs and the trading cost inside the fund can really add a lot to the total expense ratio and thereby reduce your performance in terms of the fund. So what do we look like when we talk about comparative total expense ratios between actively managed funds? So in South Africa, on average, an actively managed unit trust, you're looking at just over 1.5% per annum. So if your return was going to be 10%, this means your return is now reduced to less than 8.5% because of the total expense ratio. The average total expense ratio for exchange-traded funds is only 0.33%. So it means where I was going to get 10% for the index, this means my performance is now just under 9.7%. And that all just because of the much lower total expense ratio for exchange-traded products compared to your actively managed funds. And then just the final word on cost, just remember that only looking at the TER of investment doesn't tell you the whole story. There's a lot more involved, and I really would encourage you as you embark on a journey of investments to really get comfortable with what is my investment actually costing me. Costing me in terms of transactions, costing me in terms of administration, and how much is the total expense ratio taking away from the return or the performance that I could have earned in my investment. Now, the other type of cost is tax. And whether we like it or not, this is the one thing that we all pay in some form or another. And once again, this is clearly not a direct cost, a cash flow out of your pocket, but it certainly takes away a lot of what you would have received if you did not have to pay tax. So I'm going to start with discretionary investments. Now, discretionary investments really just refer to investments where you have full discretion, meaning you can make decisions as you want to. You can invest where you want to, how much you want to, in whatever you want to. There are no limits or constraints in terms of how you can invest. But this freedom comes at a cost. All those contributions into your discretionary investments are made with after-tax money. So you first have to pay your income tax, and then whatever is left over you can use to make discretionary investments. All the distributions that you receive from discretionary investments are also taxable. This is what is referred to as a dividend withholding tax, and that is 15% of all the dividends that you receive are immediately paid away to the taxman. You only receive 85% of the dividends after that withholding tax has been taken away from you. But the growth in your investments are also taxable. This is referred to as capital gains tax. And capital gains tax really says what is the total amount of profit that I made on my investment, and after an initial exclusion of 40,000 Rand, you can effectively be taxed about 16.7% of all the capital gains that you make. So these sort of costs can actually add up. So although you have to pay these taxes, as I said, there are no constraints in terms of how much or where or what you can invest in. But let's have a look at a picture of what the impact of those taxes that you have to pay come to. So let's use an example where I'm going to invest 30,000 Rand every year, and I'm going to take it up to a maximum of 500,000 Rand. Those of you that are familiar with tax-free investments, you'll recognize some of those numbers, but I want to show you what is the impact of investing that amount of money in a discretionary account versus what is the impact if I was going to invest it in a tax-free investment. But let's start with the discretionary investment. So the very first thing that I show you there is if there were no taxes that I had to pay, based on a return of 11% per year, which is 9% capital gain and 2% dividend yield, my investment would have grown over the 30-year period to 5.7 million Rand. This is in a world where there were no taxes payable in terms of my investment. But now I said you've got to pay tax on dividends. So the dividend withholding tax, what it does is, remember, that now takes away 15% from all the money that you receive on your dividends, and it reduces your investment by 6.4% after 30 years. So instead of 5.7 million Rand, you're only going to be left with 5.3 million Rand. Still not bad, but you've given a whole lot of tax away. The much bigger impact, however, comes in terms of your capital gains tax, because that reduces your investment amount by another 11.6%. So now you're down to just 4.7 million Rand. And the only difference is that the one was in an environment where there was no tax payable, and the other one is just ordinary discretionary investment where you have to pay tax on your dividends as well as on your capital gains. So that tax environment over a 30-year period reduces your investment amount by 18%, which is quite a big amount of money. What if I was to invest exactly that same amount of money in a tax-free investment, same performance, same return that I get? Now all my proceeds are tax-free. I don't pay any dividend tax, I don't pay interest tax, I don't pay capital gains tax. The full benefit of that tax-free environment, however, only comes after a much longer time. So I certainly want to encourage you to realize that although you are allowed to withdraw money from a tax-free account, when you do that, you're actually robbing your future self, because your future self would have been able to have that 5.7 million Rand. But if you're going to go and take 30,000 or 50,000 up front, you're never going to get to the 5.7 million Rand. So this is really an investment where you've got to exercise quite a bit of self-control, because no one's going to say you're not allowed to touch this money. You're allowed to withdraw, but you're going to be very upset with yourself in future years when you realize that you actually gave up a lot of the benefit that could have come in the long term. So there is an annual and a lifetime limit in terms of how much we can invest in tax-free investments. 30,000 Rand per annum, lifetime limit of 500,000, which is why I used this particular set of investment criteria and say, right, again, the same return criteria there, but now because I don't have to pay any tax on my tax-free investments, I save that 6.4% of dividend withholding tax that I don't have to pay. I save the other 11.6% of capital gains tax that I don't have to pay. And that 18% that I'm saving myself on the investment of 30,000 a year up to 500,000 Rand maximum contribution, I am saving a whopping 1 million Rand in not paying tax. That's significant in anybody's books. And the only difference here was that exactly the same of money I invested in a tax-free investment rather than in a discretionary investment. That's the only difference between these two scenarios that I showed you. You can really actually save yourself a lot of tax in the long run. But now some of you might say, but what about retirement savings? What about retirement annuities? Don't we get a lot of tax benefit in terms of retirement annuities? Because what you get with a retirement annuity is you get a tax deduction up front. So if I was going to pay my 30,000 Rand a year and my tax rate is 18%, well, on that 500,000 Rand that I can invest overall in my lifetime, I can save 90,000 Rand in tax. That doesn't sound too bad, does it? But how does that compare to the million Rand that you saved in the case of the tax-free? Very, very big difference, because what happens is although all the growth is tax-free, your dividends, your capital gains, while it's inside the retirement annuity, there's lots of tax-free opportunities. But the problem is the minute you start withdrawing, when you are retired and you are now living off your retirement annuity in retirement, all the proceeds of that, so that big pot of money, the 5.7 million that it grew to, that is now taxable. So instead of saving tax up front, you now have to pay tax on the 5.7 million at the end. So you can think, save tax, pay tax, versus the tax-free account, no tax savings up front, massive tax savings at the end. And that's the big difference between these two. So the break-even point in terms of my example is that if your income tax rate is less than 18% in retirement, and there's not a lot of people that will necessarily be in that environment, but if you pay less than 18% tax, you are better off in a tax-free investment rather than in a retirement annuity. So this brings me to that very important final question that so many people ask me and say, okay, so where do I start? I hear that you talk about tax-free investments. I see that there are retirement annuities. There are discretionary investments. If I want to make my first investment, where should I make my first investment? Any guesses? Who would like to venture? Where should we put our first money? Definitely not Monte Casino. This man is a lot smarter. He said tax-free investment. Absolutely. You want to make sure that you make the maximum allowable contribution to your tax-free investment account, because that's the one that's going to give you that very, very big tax-free benefit in the long run. The important thing is just self-control, because here you've got to resist the temptation of using it like an emergency fund. So many people have put money into tax-free investments only to take it out again 6 months later because now school fees have to be paid, or, oh, you know, I forgot that I actually still need to put new tires on my car. Don't use your tax-free investment as an emergency fund saving. This is something that you want to invest for the long term to really get the full benefit of that big amount that you can have tax-free. The next step that you then go to is your retirement annuity. So after you've used the maximum 30,000 per annum on your tax-free, you go to the retirement annuity, because here you can contribute as much as 27.5% of your annual gross income, taxable income. You can contribute that to a retirement annuity fund and you don't have to pay tax on that. And this is where I want you to get clever. Because you're going to be saving on your tax, you're going to be paying less tax if you contribute to the retirement annuity. Why don't you take that money that you save in terms of tax, that you get back from the tax man because of your RA contributions, and put that money into your tax-free account? And hey, presto, now the tax man has actually invested for your tax-free account for you. This is smart using of existing allowances that government give us. We pay a lot of tax and a lot of costs for a lot of things. There are some things that we can do just to be a little bit smarter about how and where we invest our money. Just quite important in terms of this, I know that we've got a lot of representatives here tonight of investor clubs and of stockvels. Neither tax-free investments nor retirement annuity investments are available for a stockvel or for an investor club. This is something that you can only do in your personal capacity. So you can still be a member of a stockvel or of an investment club. That's great. Do your collective investment, your collective discretionary investment with your stockvel or with your investor club, but also have your personal investment in a tax-free investment and a retirement annuity if you have enough money available. So it's really only once you've maxed out your tax-free contributions, your retirement annuity contributions, that if you still have anything left to invest after that, only then should you start thinking about discretionary investments. So often people start out, the very first investment that they do is a discretionary investment, not realizing that in the process they're actually losing out on a lot of tax benefit that you can have by investing in tax-free and retirement annuities. So yeah, clearly the more you can invest, whether it's in either of the first two or in the discretionary, the more the better for you. But this would be the order in which I would be looking at putting investments in place. Start as soon as possible, keep going, and resist the temptation of digging your fingers into your own investment. I'm not going to take questions at this time because I'd rather let Mike come up now and talk to you more about ETFs in general and how they can be used in these different investment products, and then right at the end we can actually take these questions. So thank you very much. There we go.
Right, we've had the girls and the glamour. Now we've got the old blokes coming along to talk about what do we do now? Irina's very succinctly told us that costs are very important. And there's one thing in investment, and everybody says that, whether it's Warren Buffett, who's the world's most famous investor, the second wealthiest man in the world, or David Graham or John Bogle or any of these people who are known globally as being real experts in investment. The one thing they say is get into low-cost investments. I think Irina explained very well how it's important to be in low-cost investments. Passive index tracking investments and ETFs are exactly what passive low-cost index tracking investments are all about. That's what I'm going to talk about. The other thing she also spoke about is tax, and I think it's very important. And I'm going to raise talk about tax-free savings accounts, and a little bit about ETFs and how they work. But then also I know a lot of you, and we've got Moss and all these pals and Thomas and so on, with lots of people here from stockvels, investor clubs. We'll talk about those. Because investing is a group where you all get together and you talk about investments, maybe have a couple of beers or a cup of tea afterwards. That's the way to learn about markets. But you can also, investing as a group, be much more successful in how you can pool your minds and pool your knowledge in investments. And then finally, I'll just finish on talking about using ETFs, exchange-traded funds, in discretionary portfolios. This time around, we're not really talking in detail about retirement investments. We've got a seminar coming up on the 26th of October here at the JSE. Well, if you live in Pretoria, we've got one in Pretoria on the 13th of October at the CSIR, and there we'll talk specifically about retirement, living annuities, and those other types of investments which really are where we can leverage tax. So what are ETFs? Well, I think Noreen has explained a lot of that to us. We're at the Johannesburg Stock Exchange, and this is where ETFs trade. You want to trade in ETFs? Come here. So ETFs are exchange-traded funds. They trade in a stock exchange. South Africa has only got one stock exchange, and you're standing in it. Okay? So it trades in the Johannesburg Stock Exchange, and they're exchange listed. That's why they're called exchange-traded, and they're funds. So what is a fund? A fund is just a portfolio of shares, very much like a unit trust. A lot of you know about unit trusts. And unit trusts are fine, but as Susie Ormond, who's the sort of guru in America, she's just like the Oprah Winfrey of financial markets, she says unit trusts are 19th century stuff. ETFs are 21st century. And we're all dynamic, we're all smart. We all want to be as smart as our kids, so we all know about 21st century stuff and electronic stuff and computers and internet and all the rest. And that's what ETFs are all about. They're all about today. But they're very much like unit trusts. So I'll unpack a little bit about that for those of you who know how unit trusts work, and you'll see how ETFs work in conjunction with that. And an ETF just trades on the stock exchange. Very important. Because when I go and buy a lot of investments, I've got to go and buy it from a single company, and he sells me an investment, and they control that investment, the register, who owns it, what's in it. On the exchange, ETFs trade on the stock exchange. So the stock exchange controls the price made by open discovery. They control the custodian system. There's a clearinghouse system. There's an electronic register. There's all these things that happen in the 21st century that don't happen with those over-the-counter products that sometimes you get sold. And so these are nice, modern products. And as Narina said, they're index trackers. They track an index, so they're passive. So let's unpack what that's all about. So what's an index? Index is just a basket of shares that reflects the performance, investment performance. So it's both the capital growth and the dividends, or the interest you receive. And it's a basket of those shares. So an ETF is not a single company. It's not a single share. It's a whole basket of shares that trades on the JSE. So it's an exchange-traded fund, and a fund is a portfolio of shares. And so the index basically just measures, let's look at what an index is. What's an index? Now that's the top 40 index on the JSE. The top 40 index is the top 40 companies on the Johannesburg Stock Exchange, and those are quite important companies. And about 90% of the trade that happens on the Johannesburg Stock Exchange happens in those top 40 shares. It's one of those amazing things. You walk into a supermarket and everybody just buys the same stuff, washing powder, milk, and all the rest. So 90% of the guys just buy the same stuff in the supermarket. The other, the other 10% goes and buys the other 90% of what's left in the stock market. An index is where all the trading takes place. And this is the top 40 index in the JSE, and it's alphabetical, so it starts at Anglo Gold, Ashanti. It's a gold mining company, Anglos, Aspen, etc., etc. And just in case you're wondering, there are 2 pages, and it goes all the way down to Woolworths. So there's 40 shares in the top 40 index. Now what the JSE does, it says if we measure the performance of those top 40 shares, then we know how the market's performing. Because 90% of the trade happens in those top 40 companies. So we're measuring how those top companies perform. We're basically gauging the return of the market, because those top 40 shares represent the market. So that's what an index is. And if you own that index, or you buy that index, you're getting the return of the market. So it's quite simple as a passive investor to invest in something that gives you, through an index, the return of a market. Now how does that work? Let's just look here at these 40 shares. We've got, I've got something supposed to point a red button. There we go. So we've got all these 40 shares, and they call them market cap weighted. So what they say is some companies are bigger than other companies. So they matter more than other companies. Let's take South African breweries, SAB Miller, which makes beer. That's pretty important. And so that's a big company. And they say, well, that accounts for 13% of the trade that happens on the stock exchange. Let's take another big company, Naspers, which happens to own the biggest IT company in China, Tencent. It also owns DSTV, which is that, where the decoder keeps going down, but there's nothing you can do about it because Naspers is, they're the only guys who can give you a decoder. But that's Naspers, which is 17% of the index. Now, if you're a fund manager and you're a passive manager and you go and take all the money that people give you and you put 13% of your money into SAB Miller and 17% into Naspers and 1.2% of your money into Woolworths, because Woolworths just sells food and ladies' underwear and handkerchiefs and stuff, so it's not very useful. Okay. You replicate that index. So you can run a portfolio, a passive portfolio, where you say, I will completely replicate the index. And if you replicate the index, that's what's called passive investment. Because you don't choose the index. The stock exchange says this is the index, these are the companies that trade, and these are the biggest companies, and therefore we will weight them according to how much trade happens in those companies and how big they are, their market capitalization, size. And you replicate that index, and you perform the same as the market. So when you're listening to Stevie B or whoever you want to, Michael Avery or something like that, and he says the index went up 1% today, he's saying those 40 shares went up 1% today. Or if the index went down by 0.5%, those 40 shares collectively went down by 0.5%. Now an ETF gives you a way to buy that. You go and buy one ETF, Satrix 40, and they own that entire portfolio. So by buying Satrix 40, you own a little bit of Woolworths, a little bit of Vodacom, a little bit of Standard Bank, a lot of SAB Miller, a little bit more of Naspers, and you've got all the others thrown in. So I'm buying one share on the stock exchange, but I actually own 40 companies. Now that's a bargain. That's great. Because if I had to go and pick those 40 shares myself, I don't know which of the biggest companies are, which are the ones that trade. So this happens for me. And that's what a passive index tracking investment does. It gives you the basket of shares that represents a market. We'll talk a little bit later about that. But it's quite a simple concept. Even I can understand it. I don't need an arena to draw diagrams for me and all the rest, but that's what an index is. Now it's very cheap to do that because I don't have to go and research all these companies to find which are the best companies or not. I just buy what the companies are, what the index tells me I should buy. So even I can do that. I'll just go and buy what the index is. And so it's not expensive, but it also gives me the average return of the market. Now what sort of indices can you get? Well, you can get all sorts of indices on the JSE. There's 70 ETFs. You can buy a top 40 index, Satrix 40, Satrix or New Funds, Swix top 40. You can buy a top 50 index. You can buy an industrial index, Satrix Indy. You can buy financials, Satrix Fini or New Funds, Standard & Poor's, Givy Fini. You can buy a resources index. You can buy global indices. If you go and buy this one here, USA, DBX Tracker USA, DBX is Deutsche Bank, listed on the JSE in rands, that gives you access to the top 600 companies in America. So you own a little bit of all the top 600 companies in America. Think of any company in America, Google, Microsoft, General Motors, General Electric, Amazon. You own a little bit of those companies in America. Now, you and I wouldn't be able to go and buy shares in America. We don't have a stockbroking account. We can't get the money out of South Africa, but we can own an index tracker which gives us the performance of the American stock market or the world market. Or there we've got the Eurostoxx, top 50 shares in America, in Europe. Or we say in the next 10 years, China is going to be the place to be. And China will be the place to be because that's where all the people are. Those are the people who are going to have money and are going to be spending. You want to be in the Chinese stock market. I don't even know how to pronounce the Chinese companies on the stock market, but I can buy an ETF that gives me access to the top 130 companies in China. And so this enables you to invest not only in one or two areas of the market, but across the market. And that becomes very attractive because your ETFs or indices can give you access to shares, equities, bonds, government bonds, inflation-linked bonds, or normal fixed interest bonds, commodities. I want to invest in gold. I can buy an ETF that actually gives me ownership of gold. Buy physical gold through an ETF. Gold, that's old-fashioned. Let's buy something else. Oil, I can buy an ETF in oil. I can buy one in copper. I can buy rhodium. If anybody understands what rhodium is, you can actually go and buy an ETF that gives you exposure to rhodium, which is a very sort of technical metal. Property, listed property shares. I want to invest in the guys that own all those shopping centers and office blocks, currencies, and even cash. You can buy money market index trackers. So an index can give you exposure to the entire market. And it does that through exchange-traded funds that trade on the market. So what we're now doing is we're trying to create simple products that are easy to understand, easy to trade, easy to access, and as Narina said, are very low cost. So let's just emphasize that one. The big benefit of buying an index is you buy one ETF, but you own the whole portfolio of shares that make up that index. Let's take that American one. I buy the DBX USA tracker. It costs me about 25 Rand a share. It has a cost ratio of about 60 basis points, 0.6%, because you've got to take the money offshore and pay offshore allowances and all the rest. But that's about a quarter of what a unit trust would cost me to buy a USA fund. But now I own a little bit of the 600 shares. Now, if I had to go and buy that myself, and I bought those 600 shares in America, I'd have to buy stock brokerage charges, settlement charges, custodian fees, debit order fees, and all the rest 600 times. But when I buy an ETF on the market, I only pay that once. So the cost factors are tremendous. You go and pay for one beer and you suddenly find you've got a whole case of beer there. There's 24 beers or whatever it is and you only paid for one. You think, oh, that's fantastic. And you drink them before your mates understand what's going on. But or for the girls, you get something else, box of chocolates or something like that. But but that's the big advantage of the cost factors. And And Narina, I thought, explained it very well with total expense ratios and all the rest. But ETFs are right at the bottom of the cost curve. Don't let these unit trust managers, they're trying to say to you, oh, unit trusts aren't as expensive as you think and so on. In the meantime, these guys, they advertise on TV every day. They're in the most expensive buildings in the country. They're listed companies. They've got to pay shareholders and dividends to shareholders and fees to directors and all the rest. ETFs, nice and simple. Run by companies like called ETFSA, which is a nice low-cost company, runs over a 120-year-old house down in Rosebank. And as long as the house doesn't fall down, we'll stay there forever. So, we're not going to ever have any costs. We've got low costs, therefore we can offer low-cost products to investors. Now, some of you are saying, and you're all smart people because you're here, if I buy an index, I'm really just getting the average return of a market because the index measures the return of the major companies on the stock market, and it gives you the average return because some guys are selling at a higher price, some guys are buying at a lower price. The index is the average return of a market. So who wants to be average? I don't mind being average because I'm an old bloke, as long as I'm around and happy to be average. But most of you don't want to be average. But if you prepare to be average, in other words, accept the aggregate return of the market or an index return, then according to all the studies, and there's a number of these around the world, but this one's done by S&P, Standard & Poor's. These guys are going to downgrade South Africa in a couple of months' time, but they also do research into other things. They say how many around the world, whether you're in America, Europe, or South Africa, or the world, how many active managers, as Narina was explaining, these are guys who go out and try and create alpha. They're trying to outperform the index. They're trying to outperform the benchmark. How many of those people over periods of 1, 3, 5 years, 10 years, whatever it is, can actually outperform the index? And what you see there is 85%, 82% of those managers underperform the index. And that's before costs. Once you put all the costs in there, nearly all of them underperform the index. So if I buy the index, I'm outperforming 85% of the people out there. And that's not bad. If the Springbok could win 85% of their matches, we'd all be a lot happier, right? Well, Bafana could win 85% of their matches. Oh, that would be a miracle. So 85 is a high average. If you want to be a high average, 85% is a fantastic average. And you're outperforming most of the people out there at lower cost. And complete transparency, you're running products through the stock market, so your registration, custodianship, all the rest is all looked after by the exchange. There's an 800 million guarantee fund to make sure that your shares, nobody ever pinches your ownership of the shares and all the rest. These are fantastic investments. And most of the new money worldwide, in America and Europe, and increasingly in South Africa, will go into index trackers. Because in the end, for most of you, you've got other things to do. You've got to work, you've got to home, feed the kids, go out, party, and all the rest. You don't want to sit and watch your investments 24 hours a day, so you just buy the index. And the index outperforms 85% of all the people out there who tell you how good they are in managing investments. You can manage your own investments through an index, and that's very important. And so what it's doing is it's bringing investments to the people. That's what we want. So let's talk a little bit about investor clubs and stockvels, because quite a lot of you here are from stockvels and all this. And most of you know that from a legal status point of view, a stokvel, investor club, or burial society has been given a special legal status by the state. It's in fact been given an exemption from having to register as a financial provider. Because if it was taking money, as a lot of stockvels do, everybody comes and gives you money at the end of the month. You're really acting as a bank. People are giving you money and then you're giving them money back. So you should have to get a banking license. Now let me tell you something, it's bloody hard to get a banking license in South Africa. But if you're a stokvel and you're structured properly, you don't need to be registered as a bank or as a financial services company. All you need is to have a structure in place. And that structure effectively came out of the Government Gazette in 2013. It says that provided you set up a stokvel or investor club, and you set up a constitution or a founding statement, and you say that we're a group of people and we're going to set up a club for the purpose of making an investment, or pooling our money as a group and trying to make that money grow and then giving that money back to the group. In other words, we're operating as a self-contained group of people, and we've got a constitution that tells us that's what we're going to do. And if you don't want to draw up your own constitution, then don't go to a lawyer. because you can download a constitution on the ETFSA website or go into Google and say stockvel, not stockvel. Google doesn't know what a stockvel is. Investor Club on Google, and they'll probably give you a constitution for an investor club. So it's quite simple to set up that club. And all it then does, provided you stick to that constitution, it allows you as a group of people to invest as a group, which means you can all get together and pool your knowledge and what you understand and what you know. And if you're not clear about it, then you've got people like Thomas, Moss and others, there's other people here, who are going to help you. Because this is one of the big growth areas in South Africa. They say there's something like 40 billion rand sitting in stockvels at the moment. And most of that just sits in a bank. Because the banks don't tell you can go and invest this money and go and buy ETFs with it. So a stockvel is well worthwhile looking at. And really all you need if you want to open an account for a stockvel, you need a copy of a constitution, a founding statement. You then have to sign a letter or a document appointing somebody responsible to act on behalf of that stockvel. So don't go and pick that bloke who goes to the horse racing every Saturday or the girl who spends Friday night in the casino. Go and find somebody responsible, some young girl. Blokes are much less responsible, and get them to be your representative person. And you then have a letter or a statement saying that this is that person we appoint to look after the stockvel. Then all the people who are members of the stockvel or the investor club, you just run a register of those members with their names, their ID numbers, their addresses and all the rest. And that's what you need to structure as part of your ownership of who's in that investor club. And you must set up a bank account in the name of the stockvel or the investor club. You can't run the money through anybody's individual bank account. You just go and set up your own bank account, and all the banks will do this. Some are easier than others. If the banks give you a hard time, just go to the bank next door. Because these stockvels are big business. The banks really like this sort of business. But in order to open a bank account in the stockvel, you've got to have those documents. Founding statement, a constitution, a register appointing an authorized person to act on your behalf, a register of investors, a bank statement. And then you just need to provide, if you come to ETFSA and say, I want to run an account for an investor club stockvel, we then just need the FICA documents of that authorized person. In other words, his ID or her ID, proof of address, and proof of bank statements, and so on and so forth. So it's quite simple to set these clubs up. So don't get put off by the fact that everybody says it's difficult, and I've got to form a company, and I've got to get a lawyer, and I've got to get all the rest. You don't need any of that. You just need a group of responsible people who want to run an investor club stockvel. And this is a very useful way to get to understand markets. Everywhere in the world, investment and saving often starts in groups, whether it's Bangladesh or it's Russia or whatever it is. These things have been going back hundreds of years, and they're very powerful in South Africa. In terms of using exchange-traded funds and investor clubs and stockvels, well, those index trackers give you a wide variety of different assets you can invest in. They give you diversification because you're not buying one share, you're buying a whole group of shares. You can get in equities, bonds, property, other asset classes. Very low costs. Don't need investment performance. That's very important. Low investment minimums, and I'll talk a bit about that later. And they also, all these ETFs pay out dividends 4 times a year. So what you can do, you can reinvest those dividends, or you can say, well, let me take those dividends back into the bank accounts, and we'll use those dividends to pay our expenses. We've got to run bank charges. We've got to run maybe buying coffee for the guys or girls. So we can use the dividends to meet our expenses, and we'll distribute the capital gains that come from our investments. So ETFs are almost ideal for this. Now, do you need a lot of money? You don't. Because you can run these things through the ETFSA investor plan, and we'll accept investments from 1,000 Rand as a lump sum per ETF. Or if you want to do a debit order at the end of every month, 300 Rand per ETF. So if you've got 10 people all putting a couple $100 in, you can afford to, say, have 4 or 5 different ETFs you pick, and you put 300 Rand into each of those ETFs. So you can spread your investments. You can do it with small amounts of money. You're getting 4 dividends a year. What do we charge you? Well, people don't always understand percentages. 0.08% or 8 basis points means if I invest 1,000 Rand, I'll pay 80 cents up front in stock brokerage. 80 cents. Huh? And you can't buy anything for 80 cents. But that's what the stock brokerage charges. And then there's an administration fee over a year of between 0.35% and 0.65% of the value of your investment. So if you're investing 1,000 Rand it costs you 6.50 Rand 0.65 per year. 6 Rand 50 to administer that investment for 12 months, and your stock brokerage charge up front is 80 cents. So for $7, you can invest, well, your investor club can invest in ETFs. Now that's not a lot of money. I was driving home from Pretoria lunchtime today, and there was this little old bloke coming to me. He's all bent and so on. And he stopped the side of the car, and he's an old guy. And I wanted to give him 5 Rand, and then I thought, no, hell, I gave him 7 Rand. So you get 7 Rand by coming and knocking my window. We take 7 Rand a year for running your investment for 12 months and making you money and reinvesting your dividends and registering the investments for you. It's not expensive. Narina told you how critical it is to keep costs low. This is your classic investment. Low costs, easy to understand. And ETFSA, we just specialize in exchange traded funds. There's our website, you know how to get hold of us, but all our materials are outside. So that's I think, really where we can structure investments. In terms of how do you set up a portfolio for your Stockville Investor Club, well, you've got all the 70 ETFs on our website. If you go and look on the website, we do give you some recommendations of sort of portfolios you could use. I'll talk a bit more about that later. If you're a reasonable size Stockville, 100,000 Rand or more, and there's a lot of those around. There's a lot of Stockville's Investor Club that are in the millions now. Come to us and we'll give you advice on what investments to make. Or go to somebody who understands. Moss, Thomas, somebody like that. So those are nice investments, I think, to get involved in. And as Narina said, the first investment you do is a tax-free account, but maybe the first one you also look at is a Stockville or Investor Club, a group investment. Then let's look at tax-free accounts. Because this is the first investment you should be making as an individual. You can't invest in a tax-free account as a Stockville or Investor Club. It's got to be an individual with a South African ID number. And as Narina said, all your income, your dividends, your capital gains, your interest, none of that is taxed. And that's taxed in a normal investment. This is all tax-free. There's 4 dividends a year if you're in an ETF or you're in a trust. So all those dividends, you can reinvest them back into your investment and they don't get taxed. And there's a withholding tax on dividends. So that's quite important to invest 100% of your dividends and not only 85% of your dividends after withholding. Tax-free capital gains, key factor. Let's just look at some numbers. If you run a tax-free savings account, and this is what a lot of you did, because your insurance company or your bank came to you and said, we can run a tax-free savings account for you, just sign here. So you signed there, and then you're now running a tax-free savings account, and they're giving you, the last 5 years, 5.8% per annum interest. So 5.8% interest per annum over 5 years means that your 30,000 Rand, let's say you invested your total 30,000 Rand, which you're allowed to do, after 5 years it'll be worth 40,000 Rand. Okay, that's tax-free, so you made 10,000 Rand without paying tax. But interest is tax-free up to 23,000 Rand a year anyway. So why waste your money buying a savings account with your tax-free money? So what you really need to do is with your tax-free money, you need to go out and buy shares. If you bought the JSE All Share Index, which is giving you 12% return over the last 5 years per annum, that money would now be worth about 54,000 Rand. But if you bought the ETFSA tax-free equity portfolio, where we give you a portfolio of 4 different ETFs, that including international ETFs and local ones, just in equities, that's given you, in the past 5 years, 21.4% per annum return, up until February this year. 21.4% per annum return means that your 30,000 Rand after 5 years is now worth 80,000 Rand. Now you're talking. Now you're talking. And if you put 30,000 Rand a year away every year, which is your maximum you can do, for 17 years, which now adds up to 500,000 Rand, which is the maximum you can put in a tax-free savings accounts, what do you think that 21% annual return would give you after 17 years, putting 30,000 Rand a year in? I can't remember the exact number, but it's close to 7.5 million Rand, because the money's just been compounding for you for 17 years. These are fantastic investments. These are the sort of things that you've got to be quite young. All the girls here are right. Some of the blokes look a bit old, but the girls are quite young. Put this money away and just keep it there. Don't access it. Just keep it there. And when you do want to access it, it's tax-free. Because if you take money out of a retirement fund, you're paying income tax on the income you're taking out. But here you don't have any tax implications. And so these tax-free accounts globally are very popular. And I think in South Africa they'll be extremely popular as people learn to understand them. So the first thing you want to do is go into a tax-free account. 30,000 Rand per year. If you can't afford 30,000 Rand, well, we'll take investments from 1,000 Rand. You don't have to do it for yourself, you can do it for your kids. Okay? So put your kids into that. We've got quite a lot of kids that are not even born yet. There was one girl, about 2 weeks ago, I think Cheryl, or 3 weeks ago, said, I want to do a tax-free account. So we said, well, send us a birth certificate. He said, nobody's, still haven't, about a month away. So we said, well, wait till it happens, then bring us a birth certificate, and then we'll open a tax-free account. So he's starting from zero. But if you put money away for 17 years or more, when they get to university, that's their fees paid. That's their education paid. And so these are fantastic investments for kids as well. Okay, and there's various strategies you can use. I'll say you can do it from 1,000 Rand. We do offer you a whole series of portfolios in ETFSA. We can give you a balanced bonds and equity portfolio. We can give you an equity-only portfolio. As I told you, that gives you 21% return historically, last 5 years. We hope it'll do the same in the next 5 years. You want to have all your money offshore, we'll give you a foreign ETF portfolio. Because then you want the Rand to depreciate. Not appreciate as done recently, but of course Mr. Gordon and President Zuma and all the rest are doing the best to drive the Rand down, so maybe that helps you, but you can buy foreign ETFs, or if you just want to put all your money in one ETF, you can do that as well. So it's quite flexible what you can do. But your best bet is to buy an equity-only portfolio over a period of time. And so these are very easy, accessible investments. And they really should be, as Narina was saying, this is your first port of call, because that tax-free savings you're making is very, very important. Because you don't want to make a lot of money and then pay tax. It's happened to all of us. We sell that house eventually, we make some money, and the government comes along and says, hey, hang on, capital gains tax. You've got to pay me capital on your profits. There's no capital gains tax in these things. Now let's just finish on discretionary investments. For an individual, you can set up your own investment. Again, 300 Rand a month or 1,000 Rand lump sums. You can manage your own individual ETFs. We run it through ETFSA investor plan. As I said, 300 Rand a month you can start, or 1,000 Rand if you want to do lump sums. We automatically reinvest the dividends for you. We charge you between 0.35% if your investment's over R1 million, or 0.65% per annum if your investment's 300 Rand a month. You know what 0.65% per annum is on 300 Rand a month? I think it's 13 Rand 22 a year we get. For processing 12 300 Rand a month debit orders. We also pick up the debit order fees, by the way, our side of it, not the bank. The bank will charge you $20 for a debit order, but we pick up the debit order fee as the user. And the transaction brokerage charges are 8 basis points. Critical, everywhere in the world you go, they say buy low-cost investments. ETFs are designed for that. You don't want to give your money away to these guys who drive fancy cars and live in fancy buildings and, designer clothes and Jimmy Choo shoes and all the rest and so on. You want it run by nice, simple ETFs. So let's look at some strategies. If you're going to put 1,000 Rand a month away, and most of you can afford that, by the way, because it's only a beer a day. You go to the Rand Club where I normally have beers, I charge you $30 for a beer. I mean, the days when I was a youngster, you paid 17 cents for a beer, but that's a long time ago. But, so you have one less beer every day, or get somebody else to buy the beer, or one less coffee. I had a cappuccino the other day, what, $35? 30 Rand a day is 1,000 Rand a month. So you're saving 30 Rand a day, that gives you 1,000 Rand. You invest 1,000 Rand a month, you put into Satrix Indy, Satrix Industrial Index, that's an ETF. What's that worth over a period of time? Well, after 10 years, it's worth about 350,000 Rand. Just shows how the money grows. And if you keep that there for 20 years, in other words, you keep on putting that 1,000 Rand a month away for 20 years. So you just drink a little bit less coffee, which is probably quite healthy. 3 million Rand. Investment's all about time in the market, how long you stay in the market and not paying too high costs, because that's a low-cost product. And if you do a bit more than that, a woman came to see me the other day from Mafeking, and she seems to run half of Mafeking, because the more you talk to her, she said, no, well, I own that spa, and I own that beauty salon, and I own that spa, and my daughter's in fashion, and my son's running the local, whatever. So I said to her, how much money can you put away? She said, I can give you 40,000 Rand each quarter. I can give you 10,000 Rand a month, but I want to be worth 3 million Rand in 5 years. And if she puts away 10,000 Rand a month for the next 5 years and 40,000 Rand at the end of each quarter, because that's when she gets profits, that money would add up to 3 million Rand. So it's just a case of getting in the habit. Investments are a habit, putting some money away. And people like Ann Wilson, who we do our Stocks for Frocks with, and ETFSA will tell you, try and put away 10% of your money in investments every month. The other 90% you can go and blow. That's fun. You can spend on wine, woman, and a song, but the other 10% you're going to invest. And if you start young like you, and you put 10% of your salary away, you don't have to worry about saving retirement. That 10% per annum, 10% per month of your salary will pay you'll be a rich man when you get to 60, 65, because your money's there working for you. And it's compounding. And if you're getting 15% per annum return, which is quite easy in the South African market, it means your money doubles every 4.5 years. So 1 Rand becomes 2 Rand, becomes 4 Rand, becomes 8 Rand, becomes 16 Rand. Now you compound that until you're 60, and you see the wonders of compound interest. And that's where you get into the habit. And if you can't afford 1,000 Rand, well, 300 Rand a month. But if you drink a lot of beer and you put 2,000 Rand in and you stop drinking beer, then you'll have a lot more than that. If you want to run a discretionary portfolio, well, here's some ideas. You can say, well, I want to have 30% in the South African equity market, and we're giving you a couple of ETFs there, the industrial ETF, a financial ETF, a top 40 ETF. I want to have 40% offshore, USA, UK, Japan, Europe. I want to have some money in government bonds, and I want to have some money in property tracker funds, and that gives me 100% of my investment allocation. What are the returns you've got over the last 5 years? And the weighted return is 20% per annum with a diversified portfolio. So not all my eggs in one basket. And this is the sort of thing you can run as an investor club. You can say, let's allocate some money to South African and offshore equities and bonds and all the rest. And some people will tell you, well, I should do this in unit trusts. Well, the average return for multi-asset unit trusts over that same period is under 10% for low equity trusts, just over 10% for medium equity trusts, and high equity, medium equity unit trusts, 11.6%. And here's our own homemade portfolio. Actual returns over the last 5 years, giving us 20% per annum. 20% per annum means your money is doubling every 3 and a bit years. And the South African market gives you those sort of returns if you're patient. 5 years or longer. It's all about patience. But ETFs are the tool that you can use for that. All right, so individual investments. We haven't spoken today about retirement annuity funds, because that's more specialized, or living annuity funds. I don't think any of you are old enough to have a living annuity fund. But that's after you've retired, and that becomes a very important component of investment. Because you don't know it, but when you retire at 60, you're going to probably still be alive at 90, which is a horrible thought. When I want to scare my family, I say, I'm still going to be around here in 20 years' time. I say, oh, well, it's going to get worse as well. I say, yeah. But that's actually, that's what happens. So you've now got to run your retirement money for a long time. And how you run a living annuity is becoming very critical. Or we can run bespoke portfolios for you. If you give us R1 million or more, we can run bespoke portfolios for you. These individual investments we'll talk about at that 26th of October seminar. Or if you're down in Durban, it'll be on the 13th of September. Or if you're in Cape Town, it's next week on the 6th of September. But we can talk about that more at the next seminar. Okay, that's basically all I've got to say, and there's our contact details. Shall we get Nerina back and see if there's any questions from the audience? Otherwise, we've got some food sitting out there waiting.